Good morning, students. So how are you? Yes, good morning, Namrata. So students, we are into the chapter of audit of banks, chapter number 9, and we are into the last leg today of this chapter. So as you already know that we have already done portion relating to advances and portion relating to verification of other assets. Simultaneously, we have also touched upon uh, those aspects which are related to verification of assets in relation to concurrent audit. We have also learnt about general things regarding audit of banks, what special considerations are needed in audit of banks, and why these are needed. We have also learnt about the appointment process of the auditors of a bank, and learnt the difference between statutory central auditors and statutory branch auditors. And we also touched upon verification of deposits, which is part of liabilities. So today students, we shall be doing remaining part of verification of liabilities, and we shall also be trying to understand some important ratios of the banking industry. Okay, so what are these important ratios, and why an auditor needs to understand these ratios? What is the significance of all this? So we shall be discussing this shortly. So what are these ratios, students? These ratios are, first we shall discuss two of these ratios: cash reserve ratio, CRR, and statutory liquidity ratio. Okay, thereafter we shall also be doing capital reserve adequacy ratio. So first of all, we shall be taking these two ratios together, CRR and SLR. Yes. Yes, Namrata, Viraj, Kaushiki. Tell me, have you heard their names? CRR and SLR. You must have either read them while probably study economics, or you must be hearing about these regularly in news. Yes. Yes, yes. Any one of you can tell what is the significance of these ratios? Why are these ratios important? So, as far as audit aspect is concerned, we shall be coming to it later on. But before we come to the audit aspect, let us understand what do these mean, because unless you understand the significance of a matter, the significance of a term, the importance of some term, you you won't be able to design suitable audit procedures for verification of the same. Okay. Yes, Janvi is saying CRR is the amount of cash to be kept by the bank. One is for cash and one is kept as security with RBI. Yes, that's right. But what is the significance of all this? What is the important? What are these ratios? I am trying to ask you. What is the nature of these ratios? What they are used to do? Capital reserve ratio and statutory liquidity ratio. Yes. Yes, Viraj, you are also writing the names. Yes, anybody? No, Namrata for liquidity, okay. To reduce the liquidity risk of the bank, Janvi. Yes, but who uses them? Who uses them? Yes. Who uses them? For whose use these are made? Does the auditor use them? Or does the bank use them? Or does somebody else use them? Yes, Viraj. Viraj, yes, you are on the right track. So basically, CRR and SLR students, these are monetary tools. And these are monetary tools in the hands of whom? In hands of Reserve Bank of India. So who is the banking regulator? Reserve Bank of India. So these are the monetary tools in the hands of Reserve Bank of India by which RBI controls and regulates money supply. Okay. So students, CRR is cash reserve ratio. So it is the minimum amount of cash which the banks have to carry either with themselves or with or in an account with RBI or in form of balance maintained with RBI. Okay. And SLR is the amount of assets which bank has to keep, proportion of assets which the bank has to keep in cash, gold, or in form of certain securities, government securities. So students, you have to understand that both of these ratios are backed by these have legal backing. These have legal backing. So it is not that RBI is only issuing some sort of instructions or some sort of guidelines or diktats, but these ratios have got legal backing. There are provisions in Banking Regulation Act 1949. And also in Reserve Bank of India Act 1934. Requiring banks to maintain such ratios. Okay, requiring banking companies to maintain CRR. Okay, so yes, students, simultaneously let us test your current affairs knowledge also. So what is the present CRR? and SLR? Have you any idea? Can you tell? Yes, guys. कभी आपने स्टूडेंट्स ध्यान दिया होगा तो आपको मालूम होगा, कभी न्यूज सुनी होगी. So RBI reviews these things in its monetary policy meeting, which is I presume is held bi-monthly. Yes, guys. Can you tell what is the present CRR and SLR? What is the present ratio? Yes, no idea. Yes, students, Namrata, Janvi, Jai. What is the present CRR and SLR requirements for banks? Present. So these obviously these are as the money supply changes, as the economic conditions change, these ratios also change. Yes, Viraj. Viraj is writing CRR is 4.5% and SLR is 18% presently. Yes, Viraj, you are dot on. You are correct. So now, so what is how do these ratios operate? What is the importance of it? Now see, guys, if present SLR is 18%, now if after some time this SLR is increased, okay, say it becomes 20%. So what does happen? What happens? The immediate consequence of it is that banks would have to maintain higher amounts in cash and securities, in approved securities which are required. Okay. So therefore, the funds which are available for lending, these would go down. So if the RBI thinks that say the economy is too heated up, okay, inflation is rising, so RBI can increase these ratios. So immediate effect of this would be that liquidity would be sucked out of the system, okay, and less funds would be available to banks for purpose of lending, for commercial lending, and it would help in cooling down the things. Okay, so this is how these ratios operate. Ditto is the case with CRR, cash reserve ratio. Okay, and CRR, as the name signifies, as the name implies, that it is the amount of the cash, it is the percentage of cash which is required to be maintained with the bank or with RBI itself. So whereas in case of SLR, the amount can be invested in securities. So securities obviously carry a sort of a source of income to banks. Okay, the bank can take advantage of market movements, and it can also take advantage of interest rate movement. Okay, so clear to you guys, CRR and SLR. Now this, how, on what amount these ratios are calculated? These are calculated on as a part of demand and time liabilities. As a part of demand and time liabilities. Okay, so it is like CRR is 4.5% of demand and time liabilities. Okay, so you have already understood the meaning of demand and time liabilities. This we have already done. So for a quick recap, demand liabilities are saving deposits and current deposits, which are repayable on demand, and time liabilities are with time deposits, fixed deposits, like deposits in the banks, which are payable after a certain maturity period. So it is, yes, Namrata, 4.5% of net demand and time liabilities. So there are directions of RBI, there are circulars of RBI as to how these demand and time liabilities have to be arrived at. Everything is properly jotted down, which heads, which items are to be included in demand liabilities, and which items are to be included in time liabilities. Okay, so there are RBI master directions in this regard. So because this is a regulatory measure, and it has also got legal backing, so therefore it becomes very important for the banks to maintain these ratios as stipulated by Reserve Bank of India. Okay, yes guys, is that clear to you? And now you would ask that these are monetary policy tools. These are used by RBI to regulate money supply in the economy. Then why we are studying it? What is the role of auditor in it? Yes. Yes, anybody? What is, yes, anybody? What is role of auditor in CRR and SLR? How auditor comes in picture? Yes. Yes, any intelligent guesses, guys? Can you imagine what can be the role of auditor as far as CRR and SLR are concerned? What is the role of a bank auditor? What is the role of a statutory central auditor as far as CRR and SLR are concerned? Yes, none. So, students, as part of audit exercise, statutory central auditors have to certify on the correctness of CRR and SLR. So how do they do so? They verify. It is the duty of auditors to verify the correct computation of net demand and time liabilities. NDTL for short, you can. Okay. So here comes the role of auditors. Now, as I have told you that there are detailed guidelines, there are master directions of RBI in relation to computation of net demand and time liabilities. What is required to be included in net demand and time liabilities? What items, what heads of accounts are to be specifically excluded from net demand and time liabilities? Okay, like say capital, profit and loss account balance. These are not part of demand and time liabilities. These are not included. These are excluded. Okay. Similarly, say some borrower has been granted credit facilities, and it has given certain margin for those credit facilities, which is say lying in some suspense account, sundry account. So these are also excluded. Okay. So therefore there are what the auditor has to do, what the auditor has to see, he has to carry out a process walkthrough of the whole process of how the CRR and SLR are computed at the bank level, and he would also download all the master directions, all the instructions, circulars of RBI. Okay. So, and in accordance with those circulars, it would be verified whether demand and time liabilities have been computed properly or not in accordance with RBI circulars. He would also carry out a sample check. So, in respect of CRR, a return is there in form A, and in respect of SLR there is a return in form 8. Okay, so the auditor would check all these returns on sample basis and see whether CRR and SLR have been computed properly or not. Yes, Kaushiki, you are asking, can cash kept for CRR be used for SLR? No, these are separate requirements, Kaushiki. These are separate requirements. 4.5% say present CRR is there, then this is a separate requirement. This cash has to be kept aside, and SLR requirement is a separate. It is in addition to that. Okay. So clear, guys? Is the process clear to you? And students, as you can understand from the nature of these ratios, these are important for the statutory central auditors. For the statutory central auditors, they would be looking for computation of net demand and time liabilities for bank as a whole. Okay. And in earlier times it used to happen that they were also asking statutory central auditors were also asking statutory branch auditors to verify position of demand and time liabilities on certain odd dates during the year. So, but now this process of CRR and SLR is also fairly automated. Okay, so at the click of the mouse, the statutory central auditor, they can have the picture of the bank as a whole, trial balance of the bank as a whole. Okay, as on any date. Yes, Namrata. Form A and Form 8 have to be filed by bank to with RBI. So what do these form basically contain the position relating to demand and time liabilities on Fridays. So which is normally referred to in banking language as Friday reporting. Namrata, I have already answered your question. Form A relates to CRR, cash reserve ratio, and Form 8 relates to SLR, statutory liquidity ratio. And this process, whole process of computing net demand and time liabilities is centralized at the head office level of a bank. And as I have told you, nowadays this is automated also. So the auditor has to see all the controls in respect to these, that whether proper controls are there relating to correct computation of correct compilation of net demand and time liabilities. You have to understand, students, this much only, because this subtopic is also quite vast. So keeping in view limitations of your syllabus, you have to understand it in this context. Okay. Yes, clear is Namrata. Is it clear to you? So guys, my request to you is that do not leave any topic in any chapter, or for not only for bank audit, but for that matter any chapter. Say this topic on this question, CRR and SLR, say it has not come for at least 5-7 years. In last 10-11 attempts, I don't think a question has been asked. But it is not that it would never be asked. So sometimes simple simple questions are asked from relatively from those topics which students normally leave. So here those students who are thorough in their study, they perform very well. Okay, because say even in case of those students who have prepared for bank audit chapter, say they would be putting 90% of their efforts on say non-performing assets, and they would be leaving all other topics. इसका तो क्वेश्चन आता नहीं, पिछले 4-5 बार उन्होंने देखा, इसका क्वेश्चन नहीं आएगा, ये अनइम्पोर्टेंट है. Which comes in the paper, that becomes important. And any topic on any question which is in your syllabus, which is in your module, it can be asked. Okay. So clear to you guys, CRR and SLR. Now we move on to another important ratio, which is related to the capital adequacy of banks. Now this ratio is called CRAR. Its full form is capital adequacy ratio. And it is related to Basel norms, Basel III norms. Yes. Have you heard about Basel III norms, students? Yes, guys. Have you heard about Basel III norms? Yes, tell me. Anybody of you who has heard about Basel III norms? Yes, students. What are those norms? Yes, can anybody tell what are Basel III norms? Yes, Namrata, she is saying we heard it once in intermediate. Oh, there could be only touching reference. I am not talking about auditing. I am talking about it generally. So those of you who may be hearing economic news, they must have heard about Basel norms. So students, I'll tell you a brief history of Basel III norms, so that you can get a context of what you are studying. So some years ago, say about 20-25 years ago, there was a committee, Basel Committee on Banking Supervision. And what is Basel? Basel is simply, it's a city in Europe. Precisely in Switzerland, I think. So the committee met there of G10 nations, and it came out for certain guidelines for strengthening banking system. So out of the deliberations of this committee were born Basel Accords. Okay, so first came Basel I norms, and then came Basel II norms, and a few years back these were further upgraded, and Basel III norms, you get your software version upgraded, okay, 1.0, 2.0, 3.0. So similarly these norms were upgraded with the passage of time, and their outreach was also increased. Many more countries were included. Okay, so India is also following, is part of these norms. Okay, so what is the basic purpose of these norms? These norms are aimed at strengthening global banking system. So what is the core of Basel III norms? So that we shall be learning, and we shall be learning how it is linked to CRAR. Okay. So students, you have to understand that Basel III norms basically stand on three pillars. You have to remember three pillars of Basel III norms. So what are those pillars? Pillar one is improving ability of banks to absorb economic shocks. Okay. Second is improving risk management and governance practices. And third is strengthening banks' transparency and disclosure requirements. So these are the three pillars. So we shall be taking all these three pillars one by one. What do these mean? What is the significance of it? So first pillar is improving ability of banks to absorb economic shocks, which may be caused by some, say, economic conditions across the globe, or by, say, some political conditions, or say some, like war is going on in some parts of the globe. Okay. So what do these norms recommended to improve ability of banks to absorb those topics? That you have to understand what are Basel III norms all about, what are their objectives. Okay. So how can banks be absorbed from economic shocks? So Basel III norms recommend that banks should have a certain minimum capital, and this capital should be based upon the risk weighted assets of the branch. Of the bank, sorry, risk weighted assets of the bank. So what is the basic objective behind it? Say the bank has lent 10,000 crores. Okay, so the norms recommend that banks should have a certain percentage of the amount, certain minimum percentage of the amount which they have lent, calculated on the basis of risk weighted assets. So what are the risk weighted assets? So risk weighted assets, you can understand simply it as like say, when a bank advances to different sectors, say to housing sector, as housing loans, okay, say in export sector, say other agricultural sectors. So weights have been assigned to different type of advances depending upon their nature. Say in case of housing loan, say a weight of 0.50 is assigned, assume, or in some sector weight of 100% may be assigned. Here 50%, in some sectors 100% may be assigned. Because why? Because these sectors may be assumed to be too risky, whereas some sectors may not be assumed too risky. Okay, so weight is assigned. This is all part of regulatory guidelines. Okay, so like say bank has advanced 5 crore as housing loan. So weight of 50% is assigned. It means risk weighted asset is 2.50 crore. So the capital is calculated as a percentage of risk weighted assets of bank. And banks have to maintain certain minimum capital. They have to maintain minimum capital adequacy ratio, CRAR, as a percentage of its total risk based exposure. Correct? So this is also related to CRAR. So how do we calculate CRAR? That is eligible capital divided by risk weighted assets. Plus off balance sheet items. Off balance sheet items like which, like guarantees, like LCs, which might devolve upon bank on a future date. Okay. So risk weighted assets plus off balance sheet items in 200. So banks have to maintain presently CRR of 9% on ongoing basis. Now what is the, guys, now understand what is the importance of this ratio? What is the significance of this ratio? Say if a bank lends more in risky sectors, so what would happen? Risk weighted assets in case of such a bank would be more. So since banks have to maintain a minimum percentage of CRAR, obviously they would be such a bank would be required to maintain more of absolute capital. So obviously if this figure is more, then to maintain a stipulated percentage of ratio, this figure has to be increased, isn't it, guys? So this is the significance of this ratio, capital risk adequacy ratio. So clear to you guys? And what does eligible capital means? So Basel III norms also require banks to maintain certain percentage of core capital, which is tier 1 capital, and there is also tier 2 capital, and there are also other categories within these which are not in your module. So tier 1 capital is common equity capital. Okay. And tier 2 capital can include say such type of things like revaluation reserves or certain type of debts, certain type of preference shares. So these are included in tier 2 capital. So what is the distinction between that? That this is tier 1 capital is of high grade, common share capital, it is of high grade capital, and tier 2 capital is of comparatively low grade than tier 1 capital. Okay, guys. So this is one aspect of which was recommended by which was borne out by Basel III norms to protect the banks from the shocks arising out of economic conditions, so that in case of an economic downturn of events, there is no run on the deposits of the bank. So that if tomorrow say something adverse happens and all the depositors queue up to the bank for withdrawing their money, then it helps to reduce that possibility that the bank should not collapse. Okay. So you understand the significance of capital risk adequacy ratio uh, and first pillar of Basel III, that is insulating banks from economic shocks. And these norms, students, these also stipulate, this pillar also stipulates that banks also continue to conduct a process of their internal capital assessment. Okay, so such a process is known as ICAAP on ongoing basis, internal capital adequacy assessment process. Internal capital adequacy assessment process. So how do the banks do this? As part of their systems, as part of their management systems, they conduct stress testing. So what is stress testing? Stress testing is just to see, its purpose is to see that if some adverse event happens tomorrow, what would be its effect on the bank's ability to repay. So these stress tests are conducted as a part of the management policy, and these have been recommended in Basel III norms. Okay, and accordingly stipulated by Reserve Bank of India in its directions, in its guidelines. RBI has called upon banks to conduct stress testing as part of internal capital adequacy assessment process, ICAAP. Clear, students? Yes. Now we come to second pillar of Basel III norms. Which is improving risk management and governance processes. Now, what are the risks in banking industries? Yes, students. There are three types of risks in banking industry. Can you tell, students, what are those three types of risks? Yes. So first risk is credit risk. Now, what is credit risk? like students, you know that bank is in the business of lending money to its customer. So there is always risk of customers not paying on time, or defaulting on their commitments. So all the aspects related to this is included in credit risk. So what do banks do? They have a well defined credit policy. They have well defined procedures regarding sanctioning of loans. The banks carry proper credit appraisals in accordance with the guidelines framed by banks. Okay, they regularly monitor the accounts, review the operations in accounts. And they also have a policy that they that their credit is not concentrated in one area. Okay, so like say a bank is lending substantial portion of its advances to say real estate sector. So if tomorrow real estate market comes down, so there could be effect on the bank's profitability and its ability to recover the money, because the customers may not be able to pay. So again, the practical application of an old saying, which is that do not put all your eggs in one basket. So you have been hearing this old saying from your childhood, I think, that do not put all your eggs in one basket. So the same thing is with banks also. So they are not putting all their eggs in one basket uh, to avoid credit concentration. Okay, so they are internally fixed limits that they would not be lending say more than this percentage of their total advances to a particular sector. So what do these norms recommend? These norms recommend banks to improve their systems for containing these type of risks. Okay, that beforehand you should have such type of policies before the things take a move towards worse. And what another kind of risk is? Another kind of risk is market risk. So students, remember we have done investment function of the banks, that there is a treasury operations department at the head office of the banks, which is involved in treasury operations. The objective of this department is to make investments and to engage in forex and derivative activities on behalf of bank. And you have also read about SLR just now. So you can, SLR is say 18%. So say if the total you can yourself visualize that at the bank level, how what could be the magnitude of the assets. It could be in thousands of crores. Okay, so the banks have to make investments in securities, and they also make investments for usual profit making. Apart from that, so all these contain market risk. All these contain market risk, that this function is properly carried out, and internal controls of this function, of investment function, operate effectively, and there is proper segregation of duties between the various persons who are performing duties relating to investment function. Like we had studied in our second lecture, that treasury operations are divided into front office operations, middle office operations, and back office operations. So if there is not a proper segregation of duties between these functions, then it could be possible that improper or wrong decisions are taken. Okay. Yes, Namrata, Treasury Department is at the overall level of bank. Treasury Department is only at the level of bank, at the head office level, at the central office level. So normally investments you would not be seeing in most of the branches of the bank. Okay, so it would only be at the head office of the bank. However, it is possible that say head office authorizes some very few branches, say 2-4 branches, to realize those investments, to realize income from those investments. So in that case, there would be role for few branches to play. Otherwise, the questions relating to investments are not relevant in case of branches. It would be relevant only to statutory central auditor. Okay, Namrata, is it clear to you? And what is third type of risk? Third type of risk you can say is operational risk. Now, when any business operates, there is a risk. There is operational risk like of internal controls do not operate effectively, failure of internal controls, or fraud is happening. So these norms also require banks to improve their governance process relating to all these three risks. So clear second pillar. Now we come to third pillar. Third pillar of Basel III norms. Now third pillar, students, it relates to what? It relates to strengthening transparency and disclosure requirements in banks. So it just the objective of it is to exhort banks uh, to disclose what steps they are taking in respect of these things, like say the banks would disclose that how they are addressing their credit risks, what is their policy in this regard, how they are addressing their market risk and operational risks. Okay, they would also share data uh, regarding what is the say concern, what is the there are what is their absolute amount of advances in to different sectors of economy, like to real estate sector, to textiles, to electronics, to what sectors they have lent as a, for a bank as a whole. Okay, they would disclose this. Not only they would have they would have appropriate policies to improve their governance processes. Such policies would also be disclosed as part of Basel III norms. Yes, students, clear? Yes, guys. So I presume that you have a fair understanding of capital adequacy and CRAR in context of Basel III norms. Yes, Koshki, you are asking what is market risk in that. Market risk, I have already explained to you. Say whether there is a possibility whether investments of the bank are not made in accordance with the regulatory guidelines, or are not made in accordance, are not made properly. So if investments are not made properly, or these are not made in accordance with regulatory guidelines, then ultimately there is a risk that that bank can lose money, because the magnitude of amounts involved is huge, and governance process in respect of not only of credit risk but also in respect of market risk. Yes, Koshki. I hope it is clear to you, Koshki. So related to this is also verification of capital. Now we come to the liabilities part, verification of liabilities. So those of you who are referring to modules, we are at page number 9.37 of your module. Okay, so capital, obviously you would be finding it only as a statutory central auditor for bank as a whole. Okay, so all the usual audit procedures relating to capital verification apply, like in other cases, like in case of a company. You would have to verify the opening balances, you have to see authorized capital, and you would be seeing if any fresh capital has been raised during the year. You would verify it with the forms filed with regulators. Okay, so all these usual things, and we have also um, already done the requirement of CR, AR, and Basel III norms. This we have already done. Okay. So second point in the balance sheet of bank is verification of reserves and surplus. Reserves and surplus. So students, you have to understand that that banks have to maintain various type of reserves in accordance with the regulatory requirements. That statutorily, that compulsorily they would be required to say transfer certain percentage of their profits into some specified reserves. Okay, so the auditors would see whether this is in accordance with the regulatory norms, whether it is in compliance with those norms. Okay, and all other usual procedures for verifying reserve and surplus which are there in the case of company are also applicable in case of banks, like verifying brought forward balances from previous financial statements. Okay, verifying additions or deductions, and also verifying their purpose. If there is deduction from a reserve, what is its nature? Okay, whether it is permissible or not. So these kind of things in case of reserve and surplus, these items, these both items, these you would be finding only for the balance sheet of bank as a whole. Okay, at the HO level, at the head office level. Okay, so it would be relevant for statutory central auditors only, and not for statutory branch auditors. Yes, clear, guys? Is that clear? Capital reserve and surplus is clear to you? And now we come to borrowings. Deposits we have already done. Borrowings. So borrowing, students, this you would also find at the head office level. It is also a borrowings are also centralized activity. Again taken at the head office level of the bank. It is a centralized function, and it can be performed by again treasury department. Okay, so the banks, a bank can borrow from RBI, from other banks, from other financial institutions, like SIDBI, okay, NABARD, Small Industrial Development Bank of India, National Bank of Agriculture and Rural Development. Okay, so in case of borrowings also, all usual audit procedures which apply in case of uh, other borrowings, these also apply, like from the entity from whom the money has been borrowed, sending external confirmations to these in accordance with SA 505. Okay. Obtaining confirmation certificates, and yeah, it can also happen that bank has borrowed money on account of money at call and short notice. Not only I told you that banks uh, lend and borrow money as part of this process. So money lent and borrowed for a short period, for overnight or say up to 14 days, it falls within the within this nomenclature of money at call and short notice. Okay, so if money has been borrowed at money at call and short notice, then to confirm and to see that whether it is authorized, and rate of interest which is payable on this money should also be examined by the auditor. Okay, so these kind of things. So students, these now look about borrowings. Say now, if a student just skips this topic, skips this subtopic, how simple it is. You have just to remember in your mind that in context of a bank, what are borrowings all about. Okay, अगर आपको इतना याद रह गया और पेपर में कोई बोरिंग्स पे क्वेश्चन जो कि कभी पूछा नहीं जाता है नॉर्मली, इट कम्स, देन यू कैन इजीली हैंडल दैट क्वेश्चन. इस पे क्या क्वेश्चन बन सकता है कि यू आर statutory central auditor of a bank, then what audit procedures you are going to perform in case of borrowings which you have found in the balance sheet of the bank. लेकिन अगर आपको कॉन्टेक्स्ट का ही नहीं पता कि बैंक क्या बोरो करता है और उसकी स्पेसिफिक, यू डू नॉट नो स्पेसिफिक टर्म्स, ओके, that from whom the bank borrows, like you do not know that bank borrows from RBI, that you do not know that bank can also borrow money on in form of money at call and short notice. Okay, that you do not write in those procedures that bank can also borrow money from financial institutions, okay, like SIDBI or say NABARD. So you would not be able to write any proper answer to that question. Okay. So that is why I insist upon students not to leave any topic or subtopic which is there in your module. Agar if you have limitation of time, just have a cursory reading. Even while revising also, say if there is a 1 day gap between your last exam and another exam, if you are not able to go through the detailing in the relevant topic, but just try to have look at the every nook and corner of your module. Even if you had a glance of it, even for 1 or 2 minutes, you can write the answer in the exam. Yes, Namrata, money at call and short notice. This we had already done while we were doing investment function. So money at call and short notice means lending and borrowing money by the banks in money market for overnight basis. Like some bank is in requirement of some crores, it borrows from another bank for one day, for overnight. Okay, so it is money at call notice. So if it is for a little longer period, say of say up to 10 days, then it is at short notice. So these transactions are normal between various banks, financial institutions, and other eligible participants and in the money market, and these happen on a large scale. So banks borrow and lend money from each other and between financial institutions, between eligible participants regularly, and they charge interest and pay interest on that. It is as simple as that. So otherwise, if you have not even once read about this topic, and say when you open the paper and you see the word money at call and short notice, you would say is out of syllabus, or we have not read it. The paper was very bad. You would curse the paper setter. It always happens. Okay. So this is not question of this chapter. This is not question of bank audit. Say guys, like this time in CA final exams, there was a question in descriptive portion regarding to sampling. So this type of question was probably never asked in last 10 years. So it was a very simple question, but I am sure that most of the students would have left out that question. It was a very damn simple question. Who had a little knowledge of that thing, he could have written it easily. And because it was of a little unusual type, so students came out of the exam cursing the paper setter. Yes, Namrata, you are writing for how many time we have to revise audit. Yes, Namrata, it depends upon your level of understanding and your level of your capacity to remember. Say if paper demands a certain set of skills from you, and you are not able to develop those skills, then it is immaterial how many times you may revise. It is of going to be a little benefit to you. But anyhow, as a thumb rule, at least first thing is when you are understanding. So after understanding, you have to again remember the things. Okay, so this would be first step. Now by watching this video, by watching this live session, you are only understanding the things. Then next step would be remembering on your own, when you would be devoting your 2-3 days to a chapter on bank audit. That would be first step. And after that at least 2 revisions would be needed as a thumb rule, as a general thumb rule for to be followed generally. some students may be requiring more, or say some students who are very sharp, they can get away with one revision. So clear, students. Now we come to next topic on verification of liabilities, that is other liabilities. So we have already done what we have done. We have already done in the liability side. So I'll write once again. We have already done capital, reserve and surplus, deposits, borrowings, and now there is other liabilities. So what is included in other liabilities in the balance sheet of a bank? So there are few heads, students, which you have to remember, which are included in other liabilities of bank. One is bills payable. So what is bills payable? Like, say sometimes students, a customer has gone to bank for say getting a demand draft issued, or a pay order issued. Yes, Namrata, liability to pay bills. And say this draft has been issued, but as on the balance sheet date, this draft or this pay order, this is not presented for payment. Okay, it is still outstanding. So it is there under bills payable. So now with the automation, with the CBS, the most of the transactions are happening in real time through NEFT, through RTGS and IMPS. So the relative importance of this item has gone down, but still it could be there. It can be there. So the auditor would see whether there are any old outstanding items in this under this head. Okay, there should not be any old outstanding entries under this head. And second point in other liabilities is inter-office transactions, inter-office adjustments. Okay, so these transactions, this head you would find that in most of the balance sheet of branches. So why do such transactions take place at the first instance? Yes, students, inter-office adjustments. What could be the purpose of such transactions? Yes. Any ideas, guys? Any idea? What could be the purpose of such transactions? Can you figure out any one or two reason? What could be the purpose of inter-office adjustments? Yes. Any guys, any idea, any reason? Can you figure out reason? What could be the purpose of transactions between one branch and another, between one bank branch and another bank branch? To put it simply. Yes. Yes. No one still like students. One branch maybe sending cash to other branch. Okay, and the entry has not been squared up. One branch may be receiving cash from another branch, or one branch may be paying on behalf of some another branch. Like say branch may be making payment of a LC on behalf of another branch. So all these type of transactions give rise to inter-office adjustment head in the balance sheet of branches. So the credit balance which is there in inter-office adjustment account, it is shown under the head other liabilities. So again, the auditor would be seeing of any old outstanding entries, and what is the control system adopted by the bank for their reconciliation. Now that is very important. Now how these entries are reconciled, because these entries happen quite often, and a large number of entries are taking place usually at pan India basis. So now there is a separate department in some cases to carry out this reconciliation process, and this is also carried through process of automation, where old entries are identified, and proper action is taken for their striking off and for their reconciliation. Okay. So the auditor would be verifying all aspects in this regard. Clear, students? And under other liabilities could also be head related to within other liabilities others. It means provisions, like say provision for usual expenses, like provision for certain expenses incurred at the branch, which is normally made at the year end, like provision for audit fees, provision for telephone expenses, provision for generator expenses. So all kind of these things, provision for power and fuel or electricity expenses. Okay, like say if the branch is under concurrent audit, okay, so the concurrent auditor is being paid monthly fees, monthly professional charges, then that branch would be required to make a provision of concurrent auditor's remuneration for the month of March, which may not have been paid, because obviously the report of a month is paid. The report of a month is submitted only next month, and after the report is submitted, the fees becomes due. Okay, so these type of general things. And Another important item under this head, other liabilities, is interest accrued. Okay. So interest due and payable, and interest accrued but not due. Okay, it is also shown under this head, interest accrued. Okay, it is not clubbed with the figure of deposits, and it is separately shown under this head of interest accrued. So students, there are also simultaneously, I had shown you LFAR. So there might be questions in LFAR regarding these liabilities. So when you try to correlate both the things, you would be not only creating a better database of material for writing in exams, it would also be increasing your knowledge. Okay, so you can yourself see from LFAR whether there are certain points for which comments are required from statutory branch auditors in respect of other liabilities, like we had seen in case of deposits. Okay. So we'll be taking a short break of 10 minutes, guys, and then see you after 10 minutes for the remaining portion of this chapter. So see you after 10 minutes. Break for 10 minutes. Yes, break for 10 minutes. Yes, welcome back, guys. So, another point which is which is important in the balance sheet of a bank for verification is contingent liabilities. Now, contingent liabilities, students, you already know that these are the obligations arising from past events, existence of which would be confirmed only on occurrence of future events. It can happen this way also, that whether a liability uh, would actually become a liability or not, it would become known to me only after some another event happens. Like, say some litigation case is there, some matter is in appeal, say some tax matter is in appeal, there is a tax demand against the bank and it is in appeal. Okay, so what is the probability? What the decision would be taken? It depends only. It is only a future event. Its existence, whether a outflow of money would be required, it would depend upon the upon occurrence of some future event. Okay, or it could be possible that uh, that it is not possible to make a reliable estimate because circumstances are such that it is not possible to make reliable estimate, or or it is not possible to confirm that an outflow of economic resources, outflow of money would be there when some that thing happens. So these are contingent liabilities. So which accounting standard would be applicable for verification of contingent liabilities in case of a bank? Yes, students. Let's test your knowledge. Which accounting standard would be applicable for recognition of contingent liabilities in case of a bank? Which accounting standard would be applicable? Yes, guys, come on. Which accounting standard would be applicable for recognition of contingent liabilities in case of a bank? Yes, yes, Jay and Janvi have answered. Yes, Jay, you are writing correctly. It is AS29. Now, Janvi, you are writing Ind AS. So probably you have forgotten that Ind AS are not applicable to banks presently as directed by RBI. Banks are still in transition stage of moving to Ind AS. So I told you in the beginning that that accounting standards as are there in state in relevant section 133 of Companies Act 2013 and in Companies Accounts Rules 2014, these are required to be followed in case of banks. So the relevant accounting standard to be followed in case of banks would be AS29. It is not Ind AS series. Ind AS are not applicable to banks for the time being now. Students, आपने दिमाग में ये point बिठा लें आप. Because as final students, you are understanding and learning about Ind AS all the time. So obviously, your mind is taking a little time to accept this fact. Okay, so you understand clearly the meaning of contingent liability. So a liability which is contingent in nature. that it may happen or it may not happen. Say if on reporting date, if it is certain that there is an obligation to pay the money, that there is an obligation there is an obligation that outflow of money would be required to be made, that there would be outflow of economic resources, then in that case provision would be required to be made. So that is one of the important point of distinction. So if it is certain that that money outflow would be there, if it is certain as on reporting date, then obviously provision would require to be made for that expense, for that liability which is going to occur. Okay. However, if it is not certain, it is dependent upon some event which would happen at some future date, for which nothing can be stated with certainty, that whether it would lead to crystallization of some liability or not, then contingent liabilities are stated. Okay, this you have already, you are accounting students, so I presume that you know the difference between contingent liabilities and between provisions, and you know the essential differences between these two terms. Okay, so the concept is same. Only point is that we have to study this in the context of banks. So clear? Is that clear to you, students? Now we are at page number 9.45 of your module. At page number 9.45 of your module. So how contingent liabilities are disclosed in the financial statements of a bank? These are required to be disclosed on these parameters. So all these 6 points, students, you have to remember, because these are the disclosure requirements. These are the statutory requirements by which contingent liabilities are to be disclosed. Okay, so you have to remember these points as such. So one is claim against the bank not acknowledged as debts. So like what are these items? So I'll quickly go through all these items one by one before coming into detailing of all this. So claims against the bank not acknowledged as debts. So like say somebody has filed a case against the bank. Say some customer has filed a case against the bank for deficiency in services. Or say some staff member has filed a legal case against the bank. Say the employee was under suspension, and the bank has refused to part with his dues, employee dues. He was due to retire, and he has filed a case against the bank. Now, in what way the case will move, that is a future event. Okay, which would depend upon how the proceedings would take place in court of law. Okay, what is the matter involved and what are the chances that bank is going to lose? What are the chances that bank would win? Okay, so these are the types of examples which are included under this head: claims against the bank not acknowledged as debts. So basically these are claims against the bank which can result into a liability, but which have not been acknowledged so because of their contingent nature. Okay. So all points, guys, all these 6 points you have to remember by heart. Again, the same thing happens with contingent liability also, because the topic of this bank audit is so wide and so vast that say most of your times would be spent in learning about various provisions regarding NPAs. By the time you come to this portion, you are exhausted and your energies may be diminished. Okay, so you would say contingent liabilities. अरे सर वही तो है जो इंटरमीडिएट में था, ठीक है. But the point is that unless you write the specific points, the specific procedures which are there to be followed in case of a bank, you would not be able to fetch any marks. Okay, liability for partly paid investments. Now there might be some investments, some shares for which the bank may have made partial payment. Okay, so there would be a claim, there would be liability to pay for the balance money. So such money which is there in case of partly paid investments. Okay, some amount which would be likely to be paid for partly paid investments, but it is not known as on reporting date how much amount is going to be paid. Okay, so liability on account of outstanding forward exchange contracts and derivative contracts. So you know that banks indulge in forward booking of foreign exchange. Okay, so for hedging purposes, for hedging the risks, so there could be liability. So it is shown here. Guarantees given on behalf of constituents. So this I told you, like the bank may be giving guarantees on behalf of its customers. Okay, to various authorities, like to custom authorities or to various other authorities, which insist on furnishing of bank guarantees by the parties, by the clients, by the respective borrowers. So the banks issue these guarantees on a legal paper, on a stamp paper. Okay, and banks are bound by these guarantees. Say in case the parties default in their payments or in their commitments to various authorities or to various persons in whose favor these guarantees have been issued, then banks would become liable. Okay, then banks would become liable, and in those cases, such authorities or such person may invoke those guarantees. So in that case, it would become liability for the bank. Okay. So another thing is acceptances, endorsement and obligations. So all LCs which are issued by the bank for on behalf of its customers for import of some goods, for import of their raw materials. Okay, so these are these can also result into a contingent liability for the banks, because if the customer does not pay up, then since the bank has issued a letter of credit, since the bank has issued a LC, it would be liable. The LC may devolve upon the bank. So remember these two terms: guarantee, invoke, technical term, and LC is devolved when the bank is asked to pay the money, because in case of event of failure of the borrower, of the party, of the client to pay up, if the bank has issued an LC, so it is bound to honor its commitment. If the goods have been if these are in accordance with the terms of letter of credit. Okay, so what should be the audit approach in respect of contingent liabilities? What should be the audit approach of the auditor in respect of contingent liabilities? So auditor is seeking a reasonable assurance that all contingent liabilities are properly identified and properly valued. So there are two things. So one thing is that auditor would make sure that he wants to be sure that all contingent liabilities which needed to be included have in fact been included. Okay, it means that all contingent liabilities are identified and these are properly valued. Okay, if these have been identified, what is at valued means that these have been measured properly. Okay. So before coming to the audit procedures in respect of these items, the auditor should also obtain a representation from management that all of balance sheet transactions have been accounted in the books of accounts as and once when such transaction has taken place. So that is very important. So students, like in case of banks, so there is complexity of transactions. There are large number of transactions taking place every day. So obviously there should be a system in place by which such transactions are recorded. Such transactions which are in nature of contingent liability, they are also captured. Okay. So why it is so? Because if these are not captured, it can lead to frauds ultimately. Say if contingent liability is not disclosed, and in fact there was contingent liability as on reporting date, the system of bank is not there to capture those contingent liabilities. So when these crystallize, suppose and the bank is actually called to pay up the money, then obviously this would be these are in the nature of a misstatement, and these may be related to frauds, like in the popular case of a bank few years ago. You remembered that that some probably some LCs issued were not recognized by the system. Okay, and these were sent um, outside the system of the bank because the SWIFT was not reconciled with the financial reporting system of the bank, and these entries were not captured in the system of the bank. So as a result, large number of unauthorized LCs were probably issued, and ultimately the bank management was not aware, and these LCs were devolved and the bank was forced to pay the money. Okay. So Koshki, you are writing how balance money is contingent. Probably you are asking about partly paid investment. So you would be doing well to remember the definition of contingent liability, where it is stated that contingent liability may be recognized due to the reason that it is not possible to recognize the amount of it. So that is what I am trying to say. So the bank may not be having information in its hand to say that such an amount is balance amount is payable. It is not possible to put a value to it, to measure it. Okay. So all the balance sheet transactions, so off balance sheet items, contingent liabilities have been entered into after following of a procedure laid down. These are in accordance with the procedure of the bank. All the off balance sheet transactions are supported by underlying documents. Now these are backed by the documents. If some item is shown under guarantees issued, so there would be a in fact guarantee. There would be in fact a document would be there in the form of a guarantee. Copy of that guarantee would be there with the bank. Okay. So these points you can very well use in your question on concurrent audit also, because these things are all seen by are being verified by the concurrent auditor also. All year-end contingent liabilities have been disclosed. All disclosed contingent liabilities do not include crystallized liabilities which are in the nature of expense. That is very important. So contingent liabilities should only be those liabilities which are in fact contingent, in respect of which there is no certainty, which have not yet crystallized. Say if the information is available as on reporting date, that some liability has crystallized, has matured, that bank is liable to pay that amount, then obviously that would be recognized as a loss, as an expense, as a provision. A provision would require to be made in the books in respect of that liability. Okay. So the estimated amounts of financial effect of contingent liabilities are on the based on best estimates in accordance with the AS 29. So every item which is recognized in financial statements, it has to be measured properly. So in case of contingent liabilities, the relevant AS is AS 29. So in case of banks, it has to be seen that these contingent liabilities have been measured properly. Okay. In case of guarantees issued on behalf of bank's director, the bank has taken appropriate steps to ensure that effective arrangements are there so that commitments would be made out of their own resources. Okay, so that's simple. Contingent liabilities have not been disclosed on account that possibility of their outcome is remote, include the management justification. So all these points which are related to the meaning of contingent liabilities. Okay. So what are the basic suggested audit procedures? So again, so whenever you write students audit procedure, any question related to audit procedure, one strategy is to start with the system. Okay, ensure that there exists a system, that there exists a system for whereby contingent liabilities are recorded. Okay, is that clear, students? In any question of of audit procedures, say you are verifying, you are supposed to write audit procedures relating to investments, relating to verification of our investments. So you can start with whether there is a board approved policy for investments, because the auditor has, and whether that policy is in accordance with the laid down regulatory parameters, because the auditor has to see the things in the context of overall control system which has been devised by the management, and which is in accordance with the regulatory norms. Okay. So ascertain whether there are adequate internal controls to ensure that transactions giving rise to contingent liabilities are executed only by those persons authorized to do so in accordance with the laid down procedures. Like say guarantee is in fact signed by the branch in charge, branch incumbent, because it is a authorized or a delegated person in whose favor the authority has been delegated by the branch manager and who is authorized to do so. Okay, so similarly in case of LCs, ascertain whether accounting system of the bank provides for maintenance of adequate records in respect of such obligations. So that is very important, that there should exist a internal control system by which the contingent liabilities are recorded, because practically you see it is not possible for the auditor to verify contingent liabilities except in some cases. So how he would be sure that all contingent liabilities have been identified? So he would go to the system, he would go to the internal control of recording such liabilities, such contingent liabilities, and then he would see whether there are any deviations from the laid down systems and procedures, whether contingent liabilities are being recorded in accordance with that system or not. Okay. Test the completeness of recorded obligations. Now, whatever has been recorded, the auditor can test check whether it is complete or not. Okay, review the reasonableness of year-end amount of contingent liabilities in light of previous experience. Say you are auditor of a bank for last 2 years. So last year there were also contingent liabilities, and this year also there are contingent liabilities. Okay, so what And you find that when you compare the two things, you find that some liabilities which were there in the last year, these are not in the current year's list. So obviously you would inquire what has happened, why this liability which was finding a place in the list of contingent liabilities in last year is missing. What developments have happened in this case, whether it is a deliberate omission or something has happened that this contingent liability has been removed from the disclosures. Okay. So now we come to specific heads. Claims against the company, against the bank not acknowledged as debt. Remember, this was the first point. So the auditor would examine the relevant evidence like correspondence with the lawyer, with the employees, like some employee has filed a case against the bank against its unfair suspension or dismissal, which the employees think so, but say the bank thinks that employee was wrong and it has and the bank has taken correct action by suspending him. Okay, and that employee has gone to a court of law against bank's orders. So what was the case? What is the legal opinion about it? What the bank's lawyers have advised to the bank that what is the probability of their winning the case or losing the case. And not the least, a review of subsequent events would also provide evidence about completeness and valuation of claims. So after the reporting period, the auditor can dig into the subsequent periods. Say he can see in the month of April whether some development has taken place pertaining to that case, which might change the nature. Okay, so which might something might has happened that which might change its nature from contingent liabilities, so it might become a provision. Okay. Now then, liability on account of outstanding foreign forex contracts, outstanding for forward exchange contracts and derivative contracts. Okay, so all the outstanding forward exchange contracts generated from the bank systems, okay, these have to be verified and also these would be verified with the accompanying documentary evidence. Okay, so similar in case of derivative contracts which are outstanding, these can be verified from the reports generated, and guarantees given on behalf of constituents. This I have already. First thing is that there should be adequate internal controls over issue of guarantees. Who is authorized to issue the guarantee? Okay, so which type of guarantee is issued, whether margin is taken. Say in case of banks, if the customer is not customer on whose behalf guarantees to be issued to some authority, if he is not a regular borrower of the bank, he is not availing credit facilities from the bank. So banks usually insist for 100% of cash margin to safeguard their interests. Say if guarantee of 5 lakh is to be issued to custom authorities, and the bank is and the borrower is not availing credit facilities from bank, meaning the bank doesn't have any other collateral securities from the said borrower, then bank would say, bring 100% margin, keep with us a fixed deposit of equivalent amount, keep with us a fixed deposit of rupees 5 lakhs. Only then we will be issuing a guarantee. Okay, so you would be saying that then what is the benefit to the borrower? So this is the statutory requirement that he has to furnish guarantee to the statutory authorities. He would have to furnish. Otherwise, he would not be able to enjoy the concessions he wants to enjoy. Okay, unused guarantee forms, whether these are kept under proper custody. Okay, so there are blank forms. So these days, now the entire format of guarantees is there in the system. So the client, he brings the stamp paper of requisite value, and the form is and the matter in respect of which guarantees is to be issued, the required format is printed through the system, and guarantees issued after doing all the formalities and keeping any margin which is required. And in respect of margin, students, I was telling you, say if the borrower is also having credit facilities and the bank feels that he is a borrower, or he is a reputed borrower, and we are also having collateral securities of which give us considerable comfort. So then in those cases, the banks would not be insisting for 100% margin. In those cases, the banks may settle for a margin of say 15% or for say 25% or 30%, depending upon case to case basis. Okay, why it is so? Because in such a case, bank would be having comfort of collateral security, which is already mortgaged to them under some credit facility availed by that borrower. Okay, so examine the guarantee register. So there is a guarantee issued register where guarantees are issued, are entered. Okay, and it is also, and students, you have also to remember that guarantees are issued for a specific time period, say for 5 years, for 6 years, for 3 years. Okay, so the auditor would also have to see that guarantees which are disclosed in contingent liabilities, these are not expired guarantees. Because if the guarantee has expired, then it has not been invoked, okay, and till that date it is also not renewed, then the bank is not liable for those expired guarantees if these are not renewed by those authorities. So why students, it becomes important for an auditor to see that expired guarantees are not included in contingent liabilities in this figure of guarantees issued on behalf of constituents. Yes, can you figure out the reason? This is also one of the important duties of concurrent auditor also. The concurrent auditor has also to verify that expired guarantees are not included in the guarantees issued figure. Why it is so? What are the implications of it? Say if the guarantees which are expired are included in the figure of guarantees issued on behalf of constituents, can you figure out one implication of it? Any one implication of it? Yes, Koshki, Jay, Namrata. Yes, guys, try to think analytically by linking up the things. Yes, anybody? Koshki, Janvi, Namrata, Jay. Say students, if you are not, if you no inflated liabilities. So I am asking. So if say Jay, if the figure is of misleading Koshki, these are general things. I am talking about specific of it. I am talking about specific of it. आपने माइंड पे स्टूडेंट्स थोड़ा सा स्ट्रेन डालिए, ट्राई टू एनालाइज द थिंग्स. और इस चीज को दिस थिंग वी हैव रेड टुडे ओनली. Look, I am giving you a clue. I am giving you a clue. This thing we have read today only. How it is going to impact? Yes, guys, waiting for your response. No. Jay, Koshki, and no more response. And Namrata. And Viraj. Probably you are there or you are logged out. No, Koshki. CRR ratio impact. So that is not an intelligent guess. So you guys are trying to catch it up, but not properly, but in vain. अंगूर खट्टे हैं, grapes are sour. Yes, Jay, come on. Yes, try, guys. What could be the immediate implications? Yes, Koshiki is right. It would have an impact on CRAR. Well done, Koshiki. Now, this is the kind of analysis, this is the kind of thinking, guys, this is the kind of ability I want you to develop. This is the kind of thinking, this is the kind of ability I request you to develop, of linking up the things. So you remember CRIR? You already remember CRAR. It is the eligible funds divided by what? Risk-based, risk-weighted assets plus off-balance sheet items. So all off-balance sheet items are contingent liabilities multiplied by 100. So if contingent liabilities are, yes, Viraj, but you are not answered. So if say expired guarantees are included, so off balance sheet items would increase. So it would have an implication for CRAR. Capital adequacy ratio would artificially increase. So that is why, guys, that importance is given in a bank audit to verify risk weighted assets. These are, as I've told you, these are verified by the statutory branch auditors also, at the branch level also. Okay. So acceptances, endorsement and obligations. Now these relate to LCs. So there should be internal controls over LCs. Same manner as in case of guarantees. So LCs issued, these are to be verified from the records maintained by the bank. So what the bank is doing? The LCs which they are issuing through the messages through Swift, they are transmitting. So they are keeping their printouts, they are binding it in their books. Okay. So all the LCs are there from which you can verify. And there is a register which indicates the LCs issued, and if some LC has devolved, then payments made under them. Okay. Normally, payments are not required to be made under LCs. These would require to be made by the customer. Okay. But say in case some LC has devolved, then payment has to be made. And other items for which bank is there could be, and balance is residuary category. Some other items like disputed tax demands for which bank would be liable. And there are some bills for collection, guys. These are by the bank on behalf of some parties which are meant to be collected from other parties. So bank charges its commission after its charges after recovering the money. Okay. So the auditor has to verify the procedures, the control in this regard, how bills for collection are sent by the bank, and whether all the bills for collection have been included under this item, under this head. Okay. Now we come to students' auditor's report in case of a bank. So auditor's report, one thing you have to remember, students, that CARO 2020 is not applicable in case of banks. So you must be remembering that there is an exemption for CARO 2020 in respect of banks and insurance companies. So guys, 2-3 attempts back, there was a question in final. What are the, there was a, in descriptive paper, there was a question, what is the CARO reporting requirement in respect of this? It was a bank audit question. So only one line was to be written, that these requirements are not applicable to bank. So, but when you study so much information, the basic learning distinctive points, you lose their sight. You fail to remember. Okay. So these are all statutory requirements which are there in case of audit report of bank, that auditor has to state whether in his opinion balance sheet is a full and fair balance sheet containing all necessary particulars. and if it is in accordance with the governing legislation of the bank. So whether the auditor had called for any explanation, whether it had been given and whether it is satisfactory, whether or not the transactions of the bank which have come to the auditor's notice have been within the powers of the bank. Now this is specific in the audit report of a bank. Okay, whether or not the transactions of the bank which have come to the auditor's notice have been within the powers of the bank. Whether or not returns received from the branches of the bank have been found adequate for the purpose of audit. Whether profit and loss account shows a true balance or profit or loss for the period covered by such account. Any other matter. So these are the points which are there in the auditor's report, and the form of audit report is in accordance with SA 700, contents of audit report. So in SA 700 there is section on key elements of audit report. So SA 700, which relates to forming an opinion and reporting on financial statements. The same essay is applicable while drafting audit report for a bank, and accordingly SA 705, SA 701, SA 706, all these 710, 720, all reporting essays, all essays which relate to the opinion of the auditor, these are also applicable in respect of a bank. Okay. And students, one more important point, like I told you, that while conducting audit of a bank, the statutory central auditor relies on the reports of branch auditor also. Okay, and it can also happen that some branches are unaudited, because in respect of RBI guidelines nowadays, small branches are having some threshold of advances and deposits. They are not required to be audited every year. Their number comes, say, after rotation, after 3 years or 5 years. Okay, so the auditor should state in the audit report that so much number of branches are unaudited, and the total advances, deposits, and interest income and interest expenses of these branches, these unaudited branches, is so much. Okay, so why such disclosure is required? Why such disclosure is required? Yes, students, can you tell? Why such disclosure is required? Yeah, students, this kind of disclosure, which is highlighted in blue in your modules, why this kind of disclosure is required in the audit reports of a bank issued by a statutory central auditor? Yes, can you figure out? Yes, students, Viraj Desai, Kaushki, Jain, Namrata. Any guesses? What is the significance of it? Why such? Why it is prompted to an auditor to state such information in his audit report, that so much number of branches are unaudited, and this is the information consolidated advances, deposits information, and interest income and interest expense information relating to these unaudited branches. What is the purpose? Yes, you are right. Yes, Koshki, you are right. It relates to responsibility of auditor. It helps in safeguarding the interests of auditor. Say he is clearly stating, look, I am expressing my opinion on the balance sheet of bank as a whole. Out of it, out of so many branches, say 1,000 branches are unaudited, and they are as per regulatory guidelines, and this is their total advances, deposits, interest income, and interest expended figure. So obviously it relates to responsibility of auditors. Similarly, when an auditor writes, say that that the information includes branches, audited accounts of the branches which have been audited by other auditors, the purpose is same. The purpose is same to define his responsibility. To define his responsibility in the financial statements. So students, again, the important thing to remember is so all the matters which are required to be reported under section 143 subsection 3 of the Companies Act, the statutory audit report in case of companies. So these are also required to be stated, apart from the matters which are there in the governing legislation relating to banks. And remember, it is pertinent to mention that reporting requirements relating to CRR 2020 is not applicable to a banking company. Now this line, in that very attempt I was referring to, many students fail to remember. Okay, and many students answered probably wrongly that CRR 2020 is not applicable. Students, you have also read about CRR in intermediate level, but by the time you are coming to finals, you probably forget about all the basic things and all the reporting requirements required in Rule 11 of the Companies Audit and Auditors Rules, which are also there in the case of companies. So you do not have to remember it separately. All these requirements are present, are there when you are remembering the requirements for reporting in case of companies. So these are all the same requirements. Whether the company has disclosed the impact of pending litigations, whether the company has made provision as required under law for material foreseeable losses on any long-term contracts, including derivative contracts, whether there has been delay in transferring money to IEPF, Investor Education and Protection Fund, of unclaimed dividends. Okay, so all these things. So these are there in the, and now from the April 23, this point, this is not April 22, now it has changed. This point has become mandatory from 1st April 23. Audit trails. Okay, so obviously in case of banks, you know, they operate in CBS platform. So obviously they have got trail of everything, every transaction. They have got trail. Their software, their accounting system is such that it generates audit trail. So the auditor has to report that the books of accounts are maintained on a software which has a feature of recording audit trail, and the same has operated throughout the year for all transactions recorded in the software, and to see that audit trail feature has not been tampered with and audit trail has been preserved by the company. The auditor would not be liable, Jai Srivastava. Okay. So audit trail. So this is the new requirement which is applicable from 1st April 23. So guys, try to remember this requirement because this would be applicable for your November 23 exam, because this has become mandatory and it is a new requirement. No, Kaushiki, Caro 2020 is applicable now. 2014 में कहाँ आ गए आप? इससे पहले 2016 था, 2016 was there and now it is Caro 2020. So again guys, at the cost of repeating it, you would remember this point relating to audit trails, which you would be remembering as part of your audit reporting requirements in case of companies. So this point has become applicable from 1st April 2023 in respect of all companies. So this is also applicable in case of banks. Okay, Caro 2014 is not applicable for banks, Koshki. Again, any version of Caro was not applicable to banks. Any version of Caro is not applicable to banks till now. So this point, student, I am what Koshki, what you are asking, audit trail. So audit trail is a feature which helps the auditor to see whether the transactions which are recorded in the system, these are leaving their footprint. These are leaving their record. Say some transaction was changed, some parameters were changed in the masters of a borrower, then who changed it? Who carried out that transaction? Whether the system is reflecting, or interest rate was changed on a particular date, then who changed it? And what was the previous interest rate before that change? And what is now? So banks are having audit trail since the advent of a CBS system, but this reporting requirement has been made applicable for auditors from 1st April 23 in case of companies. Yes. Which points you are asking are in Companies Act, which is applicable to banks? Yes, these points, this audit trail points and these IEPF points, these are all requirements of Companies Act 2013, which are applicable to banks. Because we had learned that provisions of Companies Act are also applicable to banks so far as they are not inconsistent with the provisions of Banking Regulation Act 1949. Okay. So please break all these points of audit trail and remember all these points, that what is the auditor's duty in this regard. That one, he has to see that software has a feature of recording audit trail. One point is this, try to break it. And second duty is to see that same has been operated throughout the year for all transactions recorded in the software. It is not only operating at the year end, but it is also operating, it has also operated throughout the year. And number three, the audit trail feature has not been tampered with. Tampering means छेड़छाड़, इससे कोई it has not been tampered with, it has remained intact, and audit trail has been preserved by the company as per statutory requirements for record retention. So whatever provisions in Companies Act are there for preserving record, so audit trail is also maintained, is also preserved. So these are the reporting duties. Okay. And long form audit report, students, this we have been discussing since day one. So again, for the purpose of recapitulation, please understand that LFAR, long form audit report, is required to be submitted both by branch auditors, statutory branch auditors, and statutory central auditors. Okay, so branch auditors would be giving their comments in this report, which is in the form of a questionnaire on various aspects relating to cash, relating to investments, relating to advances, relating to deposits, relating to other liabilities. Okay, and these are LFAR sent by respective branch auditors are consolidated, okay, at the central level, and statutory auditors, central auditors, they consolidate their comments on LFAR, and it is after that it is placed before audit committee of the board, and whatever has been pointed out, what is the proposed action to be taken on the adverse comments of LFAR, which are there in the LFAR report. This is taken, and a copy of LFAR is also submitted to RBI within 60 days of submission of LFAR by statutory auditors. So within 60 days of submission of LFAR by bank statutory central auditors, and after these have been placed before the board along with the action, detail of action of what action is proposed to be taken or what action has been taken, this is submitted to RBI, Reserve Bank of India, within 60 days. Okay. So besides all this, the auditor has also to the statutory central auditors and even statutory branch auditors, they have also to issue various certificates to the branches. Okay, like report on compliance with SLR requirements. So statutory central auditors would be issuing, LFAR branch auditors and statutory central auditors. Okay, so this would be also issued by statutory central auditors. Report on treasury operations of the bank. So these are sort of certificates which are part of this audit exercise, that apart from submitting audit report, apart from submitting audited balance sheet and audit report, all these different kind of certificates or reports are included in this audit exercise. Okay, certificate on reconciliation of securities by the bank on its own account as well as portfolio management services. Some securities, like we have discussed, some securities bank is holding on behalf of its customers. Okay. So there would be a proper reconciliation. So all these things like separate report on income recognition and asset classification norms. Okay, report on whether fraud was discovered in accordance with section 143(12), 1 crore or more. Do you remember Companies Act, section 143 subsection 12? So authentication of capital adequacy ratio. Now you understand the importance why we were studying capital adequacy ratio. Okay, and there are there have been two committees of RBI, Ghosh Committee and Jilani Committee, relating to Ghosh Committee relates to frauds and malpractices. Recommendations of Ghosh Committee on frauds and malpractices, and Jilani Committee recommendations are on internal control and inspection systems. So again, these are questions in yes/no form type, and the auditors would have to answer these questions. Okay, these are applicable also to branch auditors. And certificate on claim of various interest subsidies, like say branches are also claiming various interest subsidies from various statutory authorities. Okay, like there may be government schemes in which government is reimbursing certain interest portion to say weaker sections of the society. Okay, so banks are what the banks are doing. Banks are claiming this interest subsidy from those agencies which are providing these subsidies. Okay, similarly there is interest subvention. Like say in case of export borrowers, the borrowers who are engaged in export of goods, there is a remission, there is a interest subvention of certain percentage is allowed. So say the banks are charging first interest at the rate of 8% per annum, then say 2-3% interest subvention is allowed to the customers, that is credited. So the banks are claiming these subvention from other agencies. Okay, so the auditor would have to give a certificate in this respect. So these kind of things. Okay, so is that clear, students? Is that clear? So students, we have, as I have told you, this is a very vast topic, and you have to study it in context of what is there in your study material, with a little bit of correlating, with a little bit of linking. Okay, so in this way you can prepare this chapter in a better way. We have touched upon almost all of the concepts, all of the topics of this chapter. So day after tomorrow, students, we shall be doing chapter on audit of insurance companies. So my request to all of you is, there is only one lecture of this chapter. So I would only be able to either to answer your queries or to understand you concepts through certain questions. So it is better to come prepared by seeing the recorded lecture of audit of insurance companies, or by going through the module. So you have a first-hand understanding of what the chapter is all about. So it would be easy for us to to understand the key points of this chapter and to understand also any doubts, any queries of yours which may be pertaining to this chapter. Okay, guys. So see you day after tomorrow on 5th of July. Okay, guys. Thank you, guys. Thank you so much. It's over for today. Yes.